This is shocking. I'm your host, Steve Metre, and thanks for joining me today. In our show today, this major bank just crossed the line as it's given unthinkable orders to its customers. And this is one time, as you're about to see, that perhaps its customers should not take the bank's advice. Now let's head over to Bloomberg, where he picked today's story up with a headline: as Citigroup calls time on the popular Trump trade in the bond market, as the bank's global macro strategy team on Friday recommended clients exit any remaining bets that 30-year treasuries will underperform 5-year notes after taking profit on half of the position earlier this month. And just after the bank closes out, now it tells its clients to get out, suggesting that something has changed about the economy. But this is one time the bank's customers perhaps shouldn't heed the bank's warnings. The gap between the 5-year and 30-year yields has increased to 38 basis points from around 20 when Citigroup first recommended the trade, as they believed that this would be a boost for 30-year yields. And you can see on this chart here that 5-year yields shown in red against 30-year, there are times they trade together. In fact, we can go back to the 1970s into the mid-80s, and you see they were virtually in lockstep with each other. And sometimes between the mid-90s and almost early 2000s, we saw that again, and then they linked up once again around 2007, just right before we went into the global financial crisis. And then post-pandemic, we see it happen again, but this time Citibank's experts are saying perhaps the 30-year isn't where you want to be. And right now what we're seeing among investors is they're chasing short-term yields. They just don't understand the economic fundamentals of what's going on, and so they believe that short-term rates are where it's at, as Citibank is about to suggest, when perhaps the economic fundamentals is suggesting that Citibank's got it wrong, and maybe the long end is where it's really at. As strategists led by Dirk Willer touted the so-called curve steepener trade after President Joe Biden's poor debate performance in late June appeared to clear Donald Trump's path to retake the White House. Now, there's two types of curve steepeners. There's one where interest rates go higher, which is what the market believed, and that would mean put everybody short at the long end of the curve. The other one is where interest rates fall, which is now becoming the new base case. The former president's support for looser fiscal policy and steep tariffs are generally expected to deepen the federal deficit and fuel inflation, which would undermine longer-term bonds, sending yields higher and bond prices lower, which is why Citibank was likely telling its clients to be short. The trade would also benefit from a Federal Reserve move to cut interest rates, leading shorter-term maturity notes to outperform, which is why they're suggesting their clients it's time to drop the long bond. But if you're looking to trade bonds, or if you're looking to make a trade and you want to be a winner, right now we have an 85% win rate across our two reports. That's right, 39 open trades, 33 of them are up. Check this out. You want to beat the machines, you want some deep positions that have massive upside potential. That's our CTA Timer Pro. We look at when the machines get deep short and prices decline, and then when price rallies against the machines and they've got to buy, well, we flag that across major equity, bond, currency, and commodity markets. We do that daily, but maybe you like something a little smoother, a little slower, and you trade momentum, but you struggle with that. Well, we look at momentum over longer periods like the 1, 3, and 6 month window, and when we see a deep pullback in momentum and then our daily count switch to buys, well, that flags our reports as well. So you get the reports, you get every signal. I go through all the trades and give you my opinion on them. I give you stop loss levels. I track the trades, the good ones and the bad ones, and we do a weekly update on the stop loss levels. Here's the best part. While you can't duplicate my buddies' trading systems, I know I've seen them all, you can't copy them. They tell you they're getting rich, but the only person is them when you buy the report. Here's our deal. We give you a 30-day free trial because our reports are that easy. Links in the description below, because when the Fed cuts, there's going to be opportunity in the bond market, and whether you're a trader, maybe it's time to reallocate your portfolio. This will put a bunch of money in your pocket. And now as we look, we can see that indeed the 5-year treasuries do closely track compared to the 30-year treasuries, the federal funds rate that's now shown in green. And what that means is that long-term interest rates are a function of growth and inflation expectations. And so while the market started to believe that if former President Trump retook the White House, this would lead to higher long-term yields, suggesting that people would want to be long 5-year in terms of the Fed cutting rates, but short the 30-year because they believe rates would go higher. Well, now that's changing because as you're about to see in the data, it's the economic fundamentals that are suggesting that perhaps investors chasing the short end of the curve may want to look longer. And by August 2nd, Wilner's colleagues were advising investors to start trimming the position after a surprising rise in unemployment sent 5-year yields to the lowest since May of 2023, a move the strategists deemed as excessive. So what you see here is this continued belief that interest rates must go higher. Now, we do know the Fed is likely to cut in September, and even if they don't, there's going to be a few cuts on the table in the next 6 months to come, and that's going to put downward pressure on short-term yields and create, of course, an opportunity. But what about long-term yields? Many people believe they just can't go down. In fact, that's what we're hearing from Citibank. But what we can take a look at is the labor market, because Citibank's experts noted that perhaps the move was overdone. And that would make sense if you believed in the soft landing there scenario or the no landing scenario. And I'd love to know, what do you believe in? Do you think we're headed to recession or financial crisis? Or do you think the Fed really nailed it this time and we've got that Goldilocks soft landing or no landing scenario? Weigh in the comments below, because the real story here isn't the fact that they're telling their customers to get out of this trade. It's perhaps that their customers should stay in this trade because the economic fundamentals are not looking pretty. Here we can see continued unemployment claims against 5-year treasury yields. Of course, we know from a fundamental basis, when people lose their job, interest rates need to come down. And it makes a whole lot of sense, because in a debt-based economy, you need people to consume. And if interest rates are too high and people deem that as not an appropriate level to borrow and spend, or perhaps they've taken on a lot of debt and their debt service costs are keeping them from spending, then the natural direction for yields is to go lower to create money in the system, to entice people to go to the banks and borrow and spend. That's exactly what we see as people hit the unemployment line and get stuck there. As we look at continued unemployment claims in blue, what do we see with the yield on 5-year? We see it come down each and every time. And what it's trying to do is create consumption, create demand, except right now we're seeing an increase in continued claims, but you notice the market is just massively short. And of course, those positions, they can only be transitory, because at some point, if the economy continues its downward spiral, the economic fundamentals will drag yields lower, or we'll find ourselves in a very, very nasty financial crisis. And this week, stronger than expected retail sales will change people's minds, putting back to the soft landing scenarios in play, and lower than forecast jobless claims also suggest the Fed Chair Jerome Powell is less likely to signal an aggressive policy easing at the Jackson Hole Symposium in Wyoming next week. But everyone's fixated on initial claims, and we talk about that every week. The issue is, if the economy was really performing well, we'd start to see people who are on unemployment and have been there, a structural long-term unemployment issue, to get back into the workforce. But yet we continue to hear from companies that are trimming jobs. We're hearing from the manufacturing sector, and we'll look at more of that in a bit, that hours worked are getting cut even more, and that there's cutting employees on top of that, suggesting that this soft landing scenario is not likely to play out, and that yes, the Fed is concerned about this. The rate market is fully priced in a 1/4 point cut at the Fed's next policy meeting in September, and I agree that's a high likelihood, and it's 16% of a jumbo half-point reduction. But mind you, there's still another month worth of data between now and the next FOMC press conference, so we'll see what the data suggests. But as we look at the fundamentals, it tells us that the U.S. economy isn't as in great shape as the Citibank analysts suggest. That maybe while investors are fixated on the short-term return, trying to get interest on a 6-month or 1-year basis, that perhaps they're missing the bigger picture of what happens to long-term yields when the economic fundamentals fall apart. The Treasury yield curve typically steepens as the Fed starts to lower interest rates, leading policy-sensitive shorter bonds to outperform. And that is correct, with the exception of when the economic fundamentals fall apart. So right now, you see the view here. This is supported by the Citibank analysts that we're indeed seeing the soft landing scenario and that the Federal Reserve just over-tightened. They need to cut back a bit, the opportunity being in the shorter end of the curve. But hang tight, because as we get into some data that came out late last week, well, it suggests completely the opposite. And Willer said the steepener remains the right trade in the bigger picture, but it costs about 12 basis points a month to hold a position. As a result, he said, we tactically take profits on this trade and are telling our customers to do the same. But look at this. U.S. industrial production now declines by the most since January. Of course, it's being put that it's based on barrel, but we'll look at the details here because output at factories and mines have been dropping, and even worse, the prior month data is being revised. So if you think about this, if we're seeing a soft landing scenario, if we're seeing a case where maybe the short end of the curve just declines because the Fed's going to cut rates a couple times and the long end is going to stay up or even go higher, then what we should see is something in the economy suggesting that the soft landing is real. But about to see that's not the case. The 0.6% decrease in production in factories, mines, and utilities followed a downwardly revised 0.3% advance a month earlier. The median estimate was for a 0.3% decrease, suggesting things in the manufacturing sector are far worse than what the experts believe. And manufacturing production fell 0.3%, while mining and energy extraction was unchanged. But get this, output at utilities even decreased 3.7%. Perhaps that is just a sign that consumers are cutting back on their energy usage because they no longer can afford it. This is not what you want to see if you believe that rates on the long end aren't coming down. And we can look at industrial production. We're looking at this on a year-over-year rate of change. That is in blue against 30-year treasury yields. So again, Citibank is suggesting that 30-year is going higher or staying elevated as the short end of the curve collapses due to the Fed cutting rates. But when you talk about economic fundamentals, well, industrial production matters here because it just backfeeds into consumer demand. So when consumers aren't spending, well, that means retailers aren't ordering. That means wholesalers aren't ordering, and if they're not ordering, well, manufacturers aren't producing, and then you see a decline. And that means, of course, something's wrong with the economy. And we can see here in cases where industrial production declines and even contracts as it slides below that horizontal black line. And what happens to 30-year yields? They go down. And you see it again going into the global financial crisis, and you see that along the way. Here we see it in 2011. You see it around 2014. You see it again in 2018 as we headed into the pandemic. And now you see again, the market's completely convinced that interest rates will stay high and go higher. Yet what we're finding out is there isn't enough demand in the economy. There's a structural problem here, and that's going to send the long end of the curve lower. Perhaps this is what Citibank is completely missing because everybody believes the Fed has got this nailed. Well, that is until the labor market falls apart. And manufacturing, which accounts for 3/4 of total industrial production, has struggled as the Fed has kept interest rates higher for longer. Factory surveys have been more downbeat. In fact, we talked about the New York State manufacturing surveys as it shrank for the 9th straight month, while activity in the Philly Fed region contracted for the first time in January. And when that happens, it means hours worked for employees are going to get cut. It means jobs are going to be lost. And that means economic fundamentals are saying that financial conditions are too tight, that monetary policy is too restrictive, and that if the Fed does cut rates, which they will, it means the long end of the curve is coming down. And from a duration perspective, it's where the bigger opportunity lies. But it does come with a lot of extra risk. And here you can see industrial production in blue on a year-on-year rate of change against manufacturers' new orders. So we come back to consumers here. We look at demand. If there's demand from consumers for goods, that means it's going to flow up into industrial production. And you can see very clearly where manufacturers' new orders go. Well, industrial production follows. And right now, new orders are falling off a cliff, suggesting that industrial production is soon to decline. And since we know that 30-year yields are a function of inflation and growth expectations, well, we now know growth expectations are headed down. But what about inflation? Well, capacity utilization at factories, a measure of potential output being used, fell to 77.2%. This is out of 100 from 77.5. The overall industrial utilization rate declined to 77.8%. So this is a percentage of a factory that's being utilized, and this has everything to do with inflation, because when there's demand, and of course a factory is seen as work go up, it needs to hire employees, it needs to increase hours, and this leads to inflation. And the problem is when it goes down, well, inflation's coming down with it. Here you can see capacity utilization in red against the consumer price index, that on a year-on-year rate of change. And what we can note is when capacity utilization starts to decline, well, what happens is the consumer price index with a lag tends to follow it. Here you see it again going into the dot-com bubble, a repeat of that into the global financial crisis. How about this? Right around 2014, we see a peak in capacity utilization. That says, of course, demand down from consumers. We see it ahead of the pandemic, and now we're seeing again. So what we know is if long-term yields are a function of growth and inflation expectations, then perhaps Citibank analysts have got this trade wrong, that perhaps it means long rates are coming down. In fact, the housing market's now even validating that. As U.S. home construction now falls to the slowest pace since May of 2020, you want to talk about why durable goods new orders are not at the level they need to be, why they're collapsing? We'll look no further than the housing market. And here we can see the new home industry has lost some of its luster in recent months after a strong start to the year, as a combination of still high mortgage rates and prices scare off many prospective buyers. That's boosted inventory to its highest level since 2008. It spurred builders to scale back on construction, and this flows right back to the manufacturing sector. Again, sends people to the unemployment line, drops demand down, brings inflation down. And how do you revive this economy? How do you get a debt-based economy to turn around? Well, you've got to get people to spend, and of course that means they've got to borrow and spend. And wait till we look at, of course, the banking data from this past week. But what it suggests is interest rates, not just to the short end of the curve that are tied to the Fed, but the long end are coming down as well. And here you can see new privately owned housing units started against 30-year treasury yields. And you would expect to see a stronger link to this, that when, of course, you see housing starts come down, that yields would collapse. You don't really see that. What you note is that as yields decline, housing starts go up as there's demand. Here you see the effect that higher interest rates are having an impact on housing. And unless this comes down substantially, we're talking more like 2% on the 30-year, well, we're not going to see a change in the near term. What we're going to see is more people tied to the real estate sector at the unemployment line, and it's all going to eventually snowball. Then builders who are stuck on large amounts of inventory will be forced to discount them. That will impact the resale market that's already facing some new regulation going into effect right about now, and it's all going to be a perfect storm for a lot of people hitting the unemployment line. That's going to cause growth expectations and inflation expectations, along with 30-year yields, to come tumbling down. And confidence among U.S. home builders slipped for the fourth straight month to its lowest point in a year in August, as the industry eagerly awaits the Federal Reserve to start cutting interest rates, because they believe something as small as a quarter or even 0.5% will change things, and it won't, because what we're seeing is 30-year mortgage rates now down to 6.5%, their lowest level since May of 2023. And as this next chart shows, it's not making any difference, because what we're seeing now is consumers are tapped out. They've driven their savings rates down to virtually nothing. They're seeing their friends lose their job. They're seeing their hours get cut, and some of them are sitting on the unemployment line, and that's not a recipe for buying a house at all, because here you can see home builder confidence is way up here. Home buyer confidence, despite interest rates coming down a little bit, is tumbling, suggesting we're going to see another financial crisis in the housing market, on top of the fact we know the small and mid-sized regional banks are already insolvent. And building permits, which point to future construction, decreased 4% to a 1.4 million annualized rate, as applications to build single-family homes eased to the lowest since May of 2023. while authorizations for multifamily projects fell more than 11%. Of course, all that adds up to is more people on the unemployment line. And what we can see from the banking data is it makes perfect sense why interest rates need to come down. Because when we look at commercial industrial lending, this is the weekly data shown on a year-over-year rate of change in blue. And here's what I want you to think, that if there is demand for money at a certain rate, then we should see, of course, that demand show up in the data. But if interest rates are too high and there isn't a lot of opportunity in the economy, then what happens is interest rates need to go down as demand for lending contracts. And here we can see on a year-over-year rate of change right now, it's about 0.8%. But against this, so let's look at the 30-year yields, because what happens when you see a slowdown in commercial industrial lending? Well, what you see is then 30-year yields shown in red come down. And we see that every time, and they need to come down low enough to spur lending activity, to turn the economy around. You see that here in the dot-com bubble. We see a contraction in that sense, 30-year yields down. We see it again during the global financial crisis. We see it where we almost faced a double dip recession. We see it again coming into the pandemic. And now again, the market's saying no, rates need to stay here. City analysts say we don't think 30-year rates are coming down, but what the actual economy is suggesting based on a fundamental basis, what we're seeing in the lending data, the housing market, industrial production, and in the labor market is that we are not just headed for a soft landing. We're not headed to a no landing. We're headed to a recession, and that will be the best case possible, because as it looks right now, we're headed to another financial crisis. When that happens, look for the long end of the curve to come crashing down, along with the short end, as the Fed chases the funds rate all the way back to zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.